Hello everyone. Today we are going to discuss about cost and management accounting introduction chapter. So first of all, what do you mean by cost? Cost is nothing but the cost of production for each cost object. That is, we have to determine the cost of a product or a service in order to buy and also to sell. So while selling, you have to understand the cost of a product in order to fix the selling price and also to earn profit on such product or service. So cost is very important for the business perspective as well as for the customer perspective for making the buying decisions. Okay. Now let's understand the meaning of costing. Costing is nothing but the method to ascertain and allocate cost of a product or service. So cost is a expense spent on a product or service, whereas costing is a technique to find out and allocate the cost of each product or service. In that in the further classes we will see the lot of techniques for costing. Okay, then what do you mean by cost accounting? Cost accounting is nothing but the preparation of cost sheet as and when required. As like financial statements, we also prepare cost sheet in order to find out the cost of a product or a service so that we can fix the price. And it can be prepared at any time when the business decides to introduce a new product or a service. So it's nothing but recording the expenditure and income for that particular period, and it will be followed especially by the manufacturing industry. And the cost can also be determined by a trader to add profit markup on the product to be sold. Okay, so the advantages of costing will be below mentioned, like the determination of selling price and profit for the cost object, and this cost becomes the basis for price fixation and rate negotiation. See, only if we know the cost of a product or a service, then only we can negotiate for the price. Okay, right? And there are two important aspects in costing which will be very important for the business. The first one is cost control and second one is cost reduction. A very important concept from examination point of view. So firstly, cost control means maintaining actual expenditure in consonance with predetermined set standards. I repeat, maintaining actual expenditure in consonance with predetermined set standards. So the businesses will prepare budgeted figures in advance, that is before starting the business itself, so that they can maintain, control and achieve the actual expenditure in accordance with the predetermined figures which was already budgeted. So cost control is nothing but we are going to prepare a budgeted figures in advance so that the actual expenditure is taken care and it is not exceeding the budgeted ones. Okay, whereas cost reduction means permanent reduction in cost of production without compromising its quality. Here the word permanent is to be emphasized. We are going to reduce the cost of a product or a service permanently by using some efficient techniques so that the cost is permanently reduced and thus price is increased to earn a higher profit. Okay, so cost reduction is nothing but attaining the efficiency level by introducing techniques which will reduce the cost permanently. Okay, so therefore the major difference between cost control and cost reduction are: cost control is a temporary one. It will be stopped once the target is achieved, whereas in case of cost reduction there is no real end for cost reduction. So whenever a better technique arises, the cost reduction will apply and it is a permanent reduction. So there is no foreseeable end for cost reduction. Okay, so cost control is nothing but comparing actual versus budgeted figures, whereas cost reduction focuses mainly on future prospects. Okay, now the next concept is about the limitations of costing. So, though there are lots of advantages in costing, there are few limitations. However, these limitations can be overcome with effective and efficient costing and management accounting. So, these are costing. First one is costing is an expensive method, right? So it needs a lot of efforts from planning committee and as well as from coordination among the workers. Okay, then there is a lot of requirement of reconciliation if the accounts are maintained separately. For example, in case of non-integrated books of accounts, we have to reconcile the financial accounts with cost accounts, so it takes a lot of time, unnecessary workload, and there arises duplication of work due to two sets of account. Okay, however, these disadvantages or limitations can be overcome by effective cost implementation, right? So I have left out a few advantages of casting earlier, so let me remind it again. So, costing fixes the responsibility for cost variance. For example, so there are lots of departments in a business. For example, sales department and production department and finance department. So in that, if purchase department, if that is purchase or production department has did some deficiency in work, and due to that the cost of a product has raised. So we can track back who has the ultimate responsibility, who did that so who was responsible for sudden price increase. Okay, so we can fix the responsibility for cost variance. That is, cost variance is nothing but the difference in actuals with budgeted ones. Okay, and the costing will also help in cost comparison among substitutes and overtime. That is, it's nothing but we can compare interfirm comparison as well as intra-firm comparisons. Okay, so if you have the cost figure, if you have the ready to go cost figures with you, the business can easily compare its cost and its cost of production with the one which is competing. Okay, so with the firms in the same industry, and as well as with the prior years, so that it can find out its performance level, whether it has improved or not, and whether it is competing with its competitors or not. Okay, so that it can attain competitive advantage, right? Now let's see what's the meaning of management accounting. So management accounting will facilitate in prospective decision making, planning, budgeting of production, control, and performance appraisal, right? So, management accounting is nothing but decision making. So, we have find out the cost figure, we have ascertained the cost, and we have also allocated the cost to various departments and various services. And now we are going to take decisions with those information. So, these decisions will help the business identify which field it should invest and which field it should not, and which will be profitable and which will be giving quality resources to the customers. And it will help in the planning, budgeting, and control, as well as in performance appraisal for its employees. For example, if the employee has worked 1000 hours for 10,000 units, which is beyond its budgeted level, then that particular employee must be rewarded so that the performance will improve even in future, right? Okay. So then what's the difference between cost accounting and management accounting? Costing mainly focuses on quantitative aspects, that is numbers and figures, whereas management accounting mainly focuses on qualitative as well as quantitative aspects. Qualitative means decision making. So only with for this decision only we are ascertaining the cost. Okay, we are maintaining the cost accounts, everything only for the purpose of decision making, right? And what's the difference between cost accounting and financial accounting, right? What, ma'am? We are already prepared financial accounting, and now why are we preparing cost accounting also? It's two work, no, ma'am. No. So, financial accounting is prepared for the purpose of ascertaining the profit of an entity, whereas cost accounting is prepared for the purpose of ascertaining cost of a product or a service, so that we can fix the selling price and retain customers. So, as per periodicity concept, we all know the entity will prepare its accounts, that is statement of accounts, for a period that is generally 1 year. So, financial accounting is prepared for 1 year, whereas cost accounting is prepared as and when required. Whenever a new product or a service introduced in a business, we prepare a new cost sheet and cost accounts. We will maintain a cost account for each product and service. Okay, already we have in the first introduction itself we have seen that cost accounting records and ascertains cost for each cost object. Okay. Okay, now let's understand the uses of costing. So, cost accounts is used by both internal and external users. In internal users, there are four main peoples. First one is policymakers. These policymakers use the cost accounts for formulating strategies for the business to outstand from its competitors. Second one is managers. These managers measure and evaluate responsibility center. As I have already said, responsibility center will be created in a business where there are lot of departments and functions. We can track back the one which has caused the price rise. Okay, and we can fix responsibility on that particular department or function. And it is also helpful for operational level staffs. How? So, operational level staffs can use cost accounting to know what and how to produce. That is, which product to produce and how much to produce, what are the specifications. Like that, they can understand the specifications needed to produce a product or a service. And last, by employees. So employees use cost accounting to know their working hours so that they can find out their incentives and performance standards for their self benefits. Okay. And external users. In external users, there are four main people who are interested in cost accounting. The first one is regulatory authorities. Who are these regulatory authorities? For example, government, income tax department, GST department. So they will be interested in knowing the cost accounts for tariff determination, subsidies, and market rate fixation. So the price of a product or a service will be determined by market demand and supply, so that the business will fix their cost within that limit. And it is also used by auditors for financial and cost audit. So absolutely, cost audit without costing is no, there is no meaning. So costing is important for cost audit and for shareholders as well. Okay, they use cost accounting to know what their business is actually doing, what are their current position. Okay, then and lastly, by creditors and lenders. Creditors and lenders will use costing to understand the repaying capacity of the company. Now, let's get into the methods of maintenance of cost records. There are two main methods. First one is integrated system and second one is non-integrated system. As we already discussed, non-integrated system is nothing but preparing financial records separately and cost accounts separately. And because of this, we have to reconcile both accounts to get this reconciliation done. We need a coordination among our workers, and it involves time and cost. Whereas in case of integrated system, both financial and cost accounts are recorded in a single system. Okay, so that there is no need of reconciliation. And this can be studied in chapter 7. So later we will discuss it in detail. So if you maintain non-integrated system of accounting, the results shown by cost accounts will be different from those of financial accounts. Okay, so that's why we need reconciliation. The next concept will go into the digital costing system. So after the commencement of digitalization, costing has improved a lot. That is, integration of different functional activities is needed for digital costing system, and digital costing system has moved the business entirely towards paperless environment, and it shows accurate and timely information, and it also shows real-time variance analysis. Okay, real-time variance analysis, that is, variance is nothing but difference between actual and budgeted figures. And it also helps in eliminating non-value added activities, so that only productive activities will be done. So it saves cost and time. So digital costing system also aids in setting standards. Okay, now let's get into the very important concept, that is cost object. Cost object is nothing but a separate cost measurement required for every so if any item requires separate cost measurement, then it will be termed as cost object. Okay, therefore cost object is nothing but a unit, job, operation, product, project, service, department or service. So whatever it may be, so any item, if it needs a separate cost measurement, then it will be treated as a cost object. For example, if a sales department, if it so if the business is very large and it has lots of department, in that one of its is a sales department, if it needs separate cost measurement, then it will also be treated as a cost object. Okay, so again I repeat, anything which requires a separate measurement of cost will be treated as cost object. So and then next concept is cost unit. Cost unit is nothing but so the unit of measurement for each cost object. Okay, so we have find out the cost object, and now we are going to ascertain the unit of measurement for each cost object. For example, so if the cost object is liquid, then the cost unit might be liter. If the cost object is distance, then the cost unit might be kilometer. And if it is weight, it will be kilogram. If it is area, it will be acre. Right? So this is what the interrelationship between cost object and cost unit. For cost object, we are finding out cost unit. Okay, now we are getting into the next concept, cost driver. Cost driver is nothing but the factor which is influencing the level of cost. So the factor which is affecting the level of cost is known as cost driver. For example, the same example, let us take the distance. So for distance, the cost unit is kilometer, and for the same, the cost driver is number of kilometers traveled. Okay, so in business perspective, number of purchase orders for purchase department and number of machine hours for machining, these are all examples for cost driver. These cost driver, if there is any change in these cost driver, there is increase or decrease, it will be directly reflected in the cost figures. Okay, if cost driver increases, the cost figure will also increase, and vice versa. And next we are going to see about a very important concept, that is responsibility center. Responsibility center, as we already discussed, it is tracking back to the department or function, so having such responsibility. Okay, so this responsibility center is of 4 types. The first one is cost center, second one revenue center, third one profit center, and fourth one is investment center. So cost center is accountable for incurrence of costs. Cost center is accountable only for incurrence of cost. So for example, so there is a purchase department, it will be given responsibility only for incurring cost and not for revenue accumulation or investment or profit earning, etc. Okay, likewise in revenue center, it is accountable for generating revenue. Example, sales department. Sales department can collect from customers for the products sold, so that it is responsible only for generating income and not for incurrence of cost. Okay, and the profit center is responsible for both generation of revenue and incurrence of expenditure. For example, decentralized branches. Okay, so in a very big business, a particular unit may be decentralized. In that decentralized branch, So it will be responsible for both revenue and expenditure, so that profit will be achieved. Okay. And finally, investment center is accountable for both profit as well as investment, right? It can make investment on its own. Okay. So for example, Maharatna, Navaratna and many Ratna public sector undertakings will come under the investment centers. Okay, it does not need any approval from the higher upper office. Okay. Next, we are going to discuss about classification of cost. Cost can be classified on four or five main bases. Okay, five main bases. The first basis is nature of cost. So cost can be classified as direct material, direct labor and direct expenses. So direct is nothing but any cost which can be directly and economically identifiable in the product, that is finished goods, will be termed as direct material, labor and expenses. Whereas overheads is nothing but indirect material, labor and expenses will come under overheads. So overheads is nothing but any cost which is not directly and economically identifiable in the finished goods will be treated as overheads. So for direct cost, the example is raw material purchase cost, labor cost, and then royalty, higher charges of machinery will be come under direct cost. And for overheads, the examples are selling and distribution overhead, and then administrative overhead, and then factory overhead, that is fees paid to factory supervisors. Okay, and warehouse charges will come under overheads. Okay, and the second basis is controllability. So on the basis of controllability, the cost can be divided into two types, that is controllable cost and uncontrollable cost. So in that, controllable cost means variable cost, whereas uncontrollable cost means fixed cost. So controllable cost can be controlled at the company level, whereas uncontrollable is beyond the beyond the company's level. Okay. So for example, administrative expenses, the company cannot reduce or have control on such cost. Okay. And the third basis is normality. So the cost can be divided into two, that is normal cost and abnormal cost. In that normal cost means real cost, that is which is actually needed for a product to produce. So actual cost incurred. Okay. And so which is actually needed for the product to produce. Okay. And abnormal cost is nothing but the cost in excess of normal cost will be treated as abnormal cost, and it will be charged to costing P&L account. Okay. So normal cost will come under the cost of production, whereas in case of abnormal cost will go to costing P&L account. Okay. And on the basis of variability, the cost can be classified into fixed cost, variable cost and semi-variable cost. So in that, fixed cost means total fixed cost remains constant irrespective of the level of production. So very important concept. So total fixed cost remains constant irrespective of the level of production, and fixed cost per unit is inversely proportional with level of production. And any change in fixed cost means change in total fixed cost. Okay. Example, admin overhead. So for example, if you take the admin overhead, so whether you run the business, whether you shut down the business, no matter what, so you have to incur expenses on rent and electricity. So these costs are fixed in nature. It will not change with respect to the level of production. Even if you produce 1 unit or 1,000 unit, that doesn't matter for the fixed cost. So total fixed cost will remain same, whereas the fixed cost per unit, as the fixed cost is constant, the fixed cost per unit will decrease. So when the production increases, and if the production decreases, so the fixed cost per unit will increase. Okay, and thus any change in the fixed cost means change in total fixed cost, because total fixed cost is is constant. It is same for all level of production. So if at all there is any change in fixed cost, it will be affected only on total fixed cost. Okay, so it is the real cost. Okay, likewise variable cost means variable cost per unit remains constant irrespective of the level of production, and total variable cost is directly proportional with level of production. Therefore any change in variable cost means change in variable cost per unit. Example, direct material, labor and expenses. So whatever the cost which is coming before the cost of production will be treated as variable cost if the question is silent. Okay, and so variable cost means we already seen that variable cost per unit remains constant. For example, the material cost, if you purchase 1 unit, the cost will be rupees 10. If you can purchase 10,000 units also, the same 10 rupees will continue. Okay, so the per unit remains constant. Whereas the total variable cost, that is, if you multiply, so 1 unit with 10 rupees, it will be just 10 rupees, and if you multiply 10,000 units with 10 rupees, it will be 1 lakh, it will be increased to 1 lakh. Okay, so therefore so total variable cost will increase or decrease, decrease with respect to increase or decrease in level of production. Okay, so in this case, which is remaining constant, the variable cost per unit is remaining constant. So if at all, if any change happens, then the change will be applied only on variable cost per unit. Okay, so then we are going to see about the semi variable cost, very important one. So total semi variable cost will be equal to total fixed cost plus units produced into variable cost per unit. Okay, so why we have written here as units produced into variable cost per unit? Because variable cost per any change in variable cost means change in variable cost per unit. So that's why we have written here as units produced into variable cost per unit. Okay, so from so in order to find out the total semi variable in order to split the total semi variable cost into fixed and variable aspects, first let us find out the variable cost per unit. So variable cost per unit can be found out with the formula, that is the change in total semi variable cost divided by change in units. So with this we can find out the variable cost per unit. So after finding out the variable cost per unit, we can substitute this value in total semi variable cost, so that we can find out total fixed cost. And there is a very nice example for semi variable cost as well as variable and fixed cost. Let us discuss that also. So first example, if the units sold is 12,000 and units produced is 10,000, total variable cost is 70,000, variable cost per unit is 7 rupees per unit, and total fixed cost is 5 lakh rupees, and fixed cost per unit is 41.67 per unit, and the given information is 10% increase in level of activity. As a result of this, variable cost increases by 15% and fixed cost increases by 5%. So now our duty is to find out the units produced and variable cost per unit, variable cost, total fixed cost and fixed cost per unit. Now let's start with the original case, that is without the increase in level of activity. So in original case, the units produced is 10,000 units and variable cost per unit is 7 rupees, which is given in the question, and variable cost is units produced in variable cost per unit, that is 10,000 into 7 rupees. So in here we have to note one thing. I have given units sold as well as units produced in the question, but I have taken only units produced for computation of cost, because we are finding out the cost for the units produced. So we are trying to reduce the cost on units produced and not on units sold. Okay. So cost is incurred only on units produced. Okay. So that's why we are finding out cost for units produced and not for units sold. And fixed cost is equal to 5 lakh. That is total fixed cost is 5 lakh. And important one, fixed cost per unit equal to not applicable. Why? Because there is nothing called fixed cost per unit. I have just given just to test your level of understanding. So whenever fixed cost per unit is given, we should never take it into consideration. Total fixed cost should only be find out. Okay. And the revised case, in the revised case, the units produced is 11,000 units and variable cost per unit is 8.05. How? Units produced, originally it was 10,000 units and now there is 10% increase. So 10,000 plus 10% is nothing but 11,000 units, and variable cost per unit is 8.05. How? So variable cost increased by 15%. Okay. So earlier the variable cost per unit was 7 and now we are adding 7 with 15, so 15% with 7, so that the variable cost per unit will be 8.05. And we have to note here that any change in variable cost means variable cost per unit. Okay, change in variable cost per unit and not on total variable cost. So now the total variable cost is equal to units produced into variable cost per unit, which is equal to 11,000 into 8.05. And total fixed cost is equal to 5 lakh plus 5%. And lastly, the fixed cost per unit is equal to not applicable. Okay. Now there is another one example for semi variable cost. So for example, 1600 units, for 1600 units cost is 33,000 rupees, and for 1200 units cost is 31,000 rupees. Then the cost for 2000 units is question mark. So we already know, in order to find out the variable cost per unit, the formula is change in total variable cost, total semi variable cost divided by change in units, which is equal to 33,000 minus 31,000 divided by 1,600 minus 1,200. Therefore the variable cost per unit will be rupees 5 per unit. And with this information we are substituting it in total semi variable cost formula, which is equal to total fixed cost plus units produced into variable cost per unit, so that we can find out the total fixed cost for any one units which is given in the question. For example, let us find the total fixed cost for 1200 units, which is equal to 31,000 minus 1200 into 5, which is equal to 25,000 rupees. And therefore the total cost for 2000 units is equal to 25,000, that is fixed cost remains constant. Okay, so we are taking the same fixed cost, that is 25,000 plus units produced into variable cost per unit, that is 2000 into 5 per unit. Therefore the total cost for 2000 units will be 35,000 rupees. Next, we are classifying the cost on the basis of managerial decision making. So the first cost classification is predetermined or standard costing. So standard is, as we already discussed, standard is nothing but predetermined, which is computed in advance before the production starts. Okay, so that it will be helpful for maintaining and controlling the actual expenditure. So it will be helpful for price fixation and cost control using variance analysis. Okay, the next classification is marginal or variable cost. So marginal variable cost is nothing but the cost increase or decrease with respect to increase or decrease in output, that is finished product. The cost incurred for one additional unit will be treated as marginal cost. And estimated cost is nothing but, so actually we didn't start any production, we didn't have the actual figures, but we are estimating, that is predicting the actual cost, is known as estimated cost. Okay, so the differential cost is nothing but we are finding out cost, that is we are finding out the change in total cost due to change in level of activity, technology, process or method of production. We are differentiating the cost for each production level, technology, process and production method. This cost includes variable and fixed attributes. Okay, and the next cost classification is imputed cost. Imputed is nothing but notional, so it does not involve any cost outlay, that is there is no cost outflow, but we are recording it in order to in order to in order to find out the opportunity cost. Okay, and capitalized cost is nothing but cost having useful life of more than 1 year will be treated as capitalized cost. And then product cost, any cost which is associated with purchase and sale of goods in case of trading company, and acquisition and conversion of materials and other all other manufacturing inputs in case of manufacturing industry will be treated as product cost. The best example is direct material, direct labor and direct expenses will come under the product cost. So therefore then the non-product cost will be treated as period cost and it will go to costing P&L account. Okay, and then the opportunity cost is nothing but the next best alternative foregone will be treated as opportunity cost. For example, so the business owner has two opportunities before him, that is invest his 10 lakh rupees in the business or deposit it in a savings bank account, so to earn an interest of 7% per annum. So in this case he is choosing to invest in the business and foregoing the next best alternative, that is depositing in a fixed savings bank account. So this 7% interest on rupees 10 lakh will be treated as opportunity cost. Okay, and shutdown cost is nothing but unavoidable cost, the cost which is incurred even though the business is shut down. Okay, so even though the business is temporarily closed will be treated as shutdown cost. For example, rent and depreciation, so though the business is not running, it has to incur cost on rent and depreciation, it is uncontrollable cost as well. Okay, and sunk cost is nothing but the cost once incurred cannot be recovered back. For example, research and development cost, so market survey cost, so before the product so products were supposed to be supposed to come into the market, the businessmen will analyze the market, so market trends, and find out the demand and supply for the product. So is the product desirable, so is the product worthful for the customers, and this market survey cost once incurred cannot be recovered back. Okay, this is known as sunk cost. Absolute cost is nothing but total cost, that is total of all the cost natures and cost classifications, totality. Okay, and discretionary cost is nothing but optional cost, so it is at the option of the company whether to incur such cost or not. So it has the control to not incur the cost. Example, advertisement cost, so if you want to so if the company wants to create a brand advertisement, then it can incur cost on advertising. If it does if it opts out of it, it is not needed to incur such cost. Okay. And period cost as we already discussed, it is opposite to product cost, the cost which is not associated with the product, and it will go to costing P&L account. And example, non-manufacturing cost. And engineered cost is nothing but the cost so which can be tracked easily. For example, cost reflecting clear cause and effect of its incurrence. For example, so if you incurred rupees 10 lakhs for the purchase of raw material in order to produce 10,000 units, then the cost of this raw material can be tracked. It can be clearly shown the cause and effect relationship between the inputs and outputs. Okay. Example, GST. And explicit or out of pocket cost. So the cost involving cash outflow will be treated as explicit or out of pocket cost. It is opposite to implicit or economic cost. So implicit or economic cost means no cash outflow. It will not be recorded in the books of accounts. Okay. It is just like a notional cost. And other than this, we are having the methods of costing, how to record cost. So the methods of costing will be ascended like marginal costing, standard costing, process costing, job costing, unit costing, batch costing, etc. So these costing methods will be learnt in subsequent classes. And these costing or